for your presentations. I'm thrilled that Vikram ended up this discussion talking about scale. I know in my world, in microfinance in Latin America, that's certainly something we're grappling with on a daily basis. But we do need to discuss some of the issues, some of the constraints that each country faces in scaling up microfinance. And so I prepared a few questions, and each of the panelists will answer each of these questions, and then we'll open up to questions from the audience. The first question I have has to do with what are the regulatory constraints to achieving scale or to achieving your individual strategic objectives over the next couple of years? And what needs to be done at the regulatory level, at a country level as a whole, in order to really allow for this greater development of the microfinance sector and allow for scaling up of microfinance institutions?
Actually, in Egypt, microfinance is done through NGOs. We are experiencing the first private sector company which are operating in microfinance, and it's not allowed to deliver itself. It's only service company that will deliver through banks. What we operate is actually limited our capability of increasing our scale. As an NGO, we have only 5 authorized signatures. 2 of them have to sign on each transaction. So operating in 46 branches in 6 governorates with only 5 authorized signatures, and there are 4 businessmen volunteered for this, and me. So it's when I be out, I have to keep 2 of the board members in Egypt to continue operations, delivering 22,000 loans per month through this process. I think is a miracle. Changing this despite that the law didn't prevent, but the previous law prevented this, we are trying to do it, but within the Egyptian government, we actually last week we discovered that the new law already presented for approval and NGOs doesn't know about it. They just designed the law without even consulting us, not even the Egyptian Network for Microfinance. So it's something that you operate in regulatory framework. You try to ease your life and they try to do some constraints for you. When we started for lending, we were very minor, so nobody actually thought what we can do. Now we are a big operations in Egypt. It's almost 1,200,000 clients with NGOs. Operating into other products will be much difficult than lending because we had the land for lending and we are a fact. But getting into other products, and this is maybe the next question we'll go. So it's actually, we are a negative regulatory framework that we operate in.
Well, as you can imagine, in China, there's really no regulation at this point, which is a problem in and of itself. I guess that's pretty typical of most countries that get involved in microfinance. It seems like there's an interest in starting, but they don't have the legislative framework in place for it, but they want to move forward and they figure that'll catch up with it. And that's certainly the case in China. Sorry, I can't see you over there. But so it's the old concept of microfinance in a small box, that it's loans to poor people, it's loans to the poorest of the poor, it's to rural borrowers, and they put microfinance in a little tiny box, and they want to, it's sort of the government wisdom that will hold interest rates, will put a cap on interest rates, will put a cap on loan sizes, and will put geographic constraints on the organization starting out. So all of these things in an attempt to control the situation, but at the same time stifle the development of the institutions. When you're a greenfield, when you're a startup, you need scale, as we just heard. And you need scale by being able to expand and go where the customers are. Customers aren't located in one central location. They're spread out over the whole operating area. So these are things that it's a process that takes place. We're well behind our colleagues here in Egypt and India in terms of the operating environment, in terms of setting up steering committees or things like this, working groups, but we're in the process now of organizing those sorts of things. The People's Bank of China has a great interest. We've met with people all the way up to the deputy governor, who said very clearly that she's very interested in microfinance, so there's no question about the interest. I think that eventually the regulation will come. And then the issue is, as Motez was saying, is that you want a process in place that allows for input and feedback from the practitioners, people that know microfinance, from actually implementing it, so that you don't get regulations that are cooked up behind corporate boardroom doors and don't have any they're not applicable in reality. And that's what I think could be a problem if we're not careful. So we need to learn the lessons that we've seen in other countries in the development process in terms of the regulatory environment, and hopefully we'll be able to get something in place. Right now we're registered as a limited liability company, which for all intents and purposes means that by the true letter of the law, we're engaging in illegal activity by lending money. So to borrowers, to individual borrowers. So our legal status in and of itself is a constraint or an issue. And then, as I said before, these issues like the caps on interest rates and the loan sizes and so on, geographic constraints, these are all also issues that will have to be dealt with as the regulation is developed.
So I'll answer this question globally, and then as it relates to India in particular. Globally, clearly the single most important regulatory move a central bank can make is deregulation of interest rates. And there's enormous amount of data out there that shows that countries that deregulate interest rates for microfinance, you have a much greater access to financial services than countries that don't. And so the regulators, the bureaucrats, the political impulse to try and protect the poor by regulating interest rate is about as misguided as you can get. And the more we can make that argument in an intelligent, data-based way, the better off access to finance will be for the poor across the world. When it comes to India and any country where deregulation has happened, in India you do have a deregulated interest rate environment, so it is favorable in that regard. The second most, and perhaps arguably the most important move that a regulator can make is to give poor people a safe place to save. Right now, what are we doing? We're giving them a loan, we're saying go earn income, and then stuff it under your mattress, put it in your blouse, tie it up in your sari. And without that safe place to save, this is a big problem for the poor. They don't have cash flow smoothing, they don't have the tools they need to truly build income, earn, create assets, and get out of poverty. So if you create a safe place to save, not only is it good for the poor, but it's also good for the microfinance institution, because if we can get low-cost funds, deposits, if we can take deposits, we can obviously pass on those cost savings to the poor. Right now, our average cost of borrowing, and I'm sure it's true for my colleagues, is in the range of 12%. Because again, banks that we borrow from see this as unsecured subprime lending. If we can get deposits, we can significantly lower that cost, and then onwards, pass that on to the borrowers. The third reason safe place for saving is good is it's good for the economy. In India, for example, we have the highest per capita consumption of gold. And all that gold is sitting on the ears and the jewelry of rural women, middle income, low income, because they have no other place to put the money. And if that money, of course gold's doing well now relatively, but if that money in a more stabilized market went into the economy, imagine how much more capital there would be to spur the macroeconomy. And there's a good McKinsey report that talks about this in the Indian context from a couple of years ago and makes a comparison where you've got high growth economies and what the per capita consumption of gold is versus India at that time, relatively speaking, had a much higher per capita consumption of gold. So it's a safe place to save is good for the poor in terms of giving them tools for poverty eradication, good for the institution because it'll lower the costs and we can pass it on to the borrower, and it's good for the economy. And the way to change this is if we can measure central bankers by how many savings account they've created for the poor, as opposed to other financial metrics, then I think we can radically change the way this happens and this works for the poor.